Okay, what if I told you that investing in a uranium explorer in, say, Niger, a place many would call incredibly risky, is actually a mathematically better bet than a similar project in the USA? It sounds completely backward, I know, but the numbers tell a fascinating and totally counterintuitive story. Let's dig into this paradox. So, on the surface, the thinking goes something like this, right? You've got a known resource in a stable country like the US, that's got to be the safe play. And then you have this early stage thing in Africa. Well, that just screams speculative gamble. This is the conventional wisdom. It's the simple story we tell ourselves. But what if that simple story is just flat out wrong? What if the cold, hard math, the actual numbers behind the risk and the reward, paints a picture that is the complete opposite of what we all assume? And that brings us to the really interesting part, the surprising math of risk. Take a look at this number, 0.72x. When you factor in all the probabilities of success and failure, the expected return for that quote-unquote safe U.S. investment is actually negative. Let me say that again. On average, you are statistically likely to lose 28 cents on every single dollar you put in. Now, compare that to this, 5.4x. The expected return for a small African explorer, even after we account for all the scary headlines and political risk, is a more than five-fold return. So how is this possible? How can the gamble be so much better than the sure thing? Well, it all comes down to this simple equation. And here's the fascinating part. Look at the probability of success. It's not actually that different. 24% in the US versus 30% in Africa. The whole game, the entire story, is right there in the next column. The return if you are successful. A win in the US might get you a 3 by X return. Not bad, but a win in Africa? We're talking an 18x return. That colossal upside completely changes the math. And this is why that upside is so different. It's what we're calling the $42 a pound advantage. This is the key insight. Finding uranium is not the hard part. The hard part is finding uranium that you can actually mine for a profit. You have to find economic uranium. And this slide just illustrates the point perfectly. The US has a ton of uranium in the ground, almost as much as Africa, yet Africa produces 45 times more. Why? Well, it's because most of those US deposits have really low ore grades, and low grades mean high costs. A lot of the uranium in the US is simply uneconomic to mine. So to really get this, you need to understand cost tiers. Think of it this way. Tier 1 mines are like a money printing machine. Tier 2 mines are very healthy, very profitable. But Tier 3 mines, they're basically on life support. They only make sense if uranium prices go to the moon. Now, let's look at how this plays out in the real world. A country like Niger can pull uranium out of the ground for less than $30 a pound. That's elite, Tier 1 stuff. Namibia is a really solid Tier 2 at around $42. But then you look at the US, way up there at $70 a pound. That's a massive structural disadvantage baked right into the geology. Okay, this is the absolute core of the entire argument. Let's say you make the exact same discovery. 20 million pounds in two different places. In Botswana, with its low-cost structure, you've just created almost $250 million in value. Fantastic. Now take that exact same discovery and put it in Wyoming. Because of the high costs, it's worth basically nothing. It might even have a negative value. You could spend millions of dollars just to find a worthless asset. So this completely forces us to rethink what risk and failure even mean in this business. It's not just about what you see on the news. Look at the US. The failure rate for these junior miners is an insane 76%. But look at why they fail. It's not because they can't find uranium. It's economic failure. The deposit just costs too much to ever make money, and permitting failure, which is just death by 1,000 cuts from regulations and legal battles. Now let's look at Africa. The failure rate is actually a little bit lower at 70%. And yeah, political risk is real. It's right there, accounting for about a fifth of failures. But the number one killer in the US, that giant economic failure slice of the pie, is a much, much smaller problem in Africa. If you find something there, chances are it's going to be profitable. And this quote just nails it perfectly. A Tier 2 deposit works regardless of who owns it. A Tier 3 deposit barely works at any price. At the end of the day, economics is king. And you see this play out with real companies. Take Global Atomic in Niger. It's a Tier 2, low-cost project. It literally went through a military coup and still delivered a 6x return to investors. because the project itself makes so much economic sense. Now compare that to energy fuels in the US. Super stable jurisdiction, but with high-cost Tier 3 assets, it's just a constant story of struggle and underdelivery. So all of this leads to a huge conclusion. You have to prioritize economics over jurisdiction. It really requires a whole new framework for how to look at these potential investments. So let's wrap this all up into a new framework. First, deposit quality, that cost here, is everything. It's more important than anything else. Second, you have to understand that the quiet structural risks in the US, permitting and economics, can be far more deadly than the loud political risks in Africa. Third, the value of a discovery comes from its profit margin, not the country it's in. And finally, just remember the sheer asymmetry of the reward. A successful project in Africa is a life-changing return. A successful one in the US is just okay. So I'll just leave you with this final question to think about. What is the real risk here? Is it a military coup that you can see on the news but that a great project can survive? Or is it the silent, invisible paralysis by 1,000 permits that makes a project worthless before you even start?